Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I would like to introduce you to my low-risk strategy to generate extra cash flow and get stocks cheaper than they are today using options. I sell put options, usually out of the money. I'll give you a quick overview of options soon. And using various analysis techniques to make sure that one, I get a premium for selling the put option, and ideally the put option contract expires worthless without my having to get the stock. Or two, I buy a good stock that I most likely would have bought anyway at a price cheaper than today, and I get the option premium as a bonus. I will not discuss call options nor buying options in this video, since the buying is more advanced, and I will cover the call options, no pun intended, in another video. I will discuss only selling put options because this is one of the safest strategies using options. As the stock market goes up over time, there's a good chance that the put option expires worthless. The downsides are that if you do get the stock, you, number one, need to have enough cash on hand or access to cash to buy the stock. And number two, you may get the stock at a higher price than the current price. However, because I am a buy and hold investor, I would have held on to the stock if it kept going down after I purchased it. So this situation is the same and it doesn't bother me. Let's first cover what a put option is. A put option is a contract which I am planning to sell for a premium that says I am going to buy a certain number of shares of a certain stock for a certain price. So in the example that you see here, I am saying that I will buy a certain stock for $40 a share. And if the stock is currently $50 a share, then it is out of the money. As the stock price goes down, when it hits 40, then it is at the money. And as it keeps going down, then it is in the money. Now, obviously, nobody's going to sell the stock to me for $40 if it is at $45 or $50. So that's why it's out of the money. But as the stock goes down, and let's say it goes down to $35, then they would say, okay, I will sell you a $35 stock for $40 as promised. That's what I paid you the premium for. And so that's in the money, and that's when I would get the shares. This is, of course, at the discretion of the purchaser of those shares. The put option also has an expiry date. So if the stock does not make it in the money by the expiry date, then it expires worthless. And of course, I had already gotten my premium. Let me introduce you to my method of selling and making money off of put options. So I have subscribed to a training company called Options Play. They're related to the TMX as well. And they have a lovely tool, which I'll show you in a little bit, but they also put out daily put reports that are optimized for you to make money off of. So this is one of the reports. It's always live. It's always updated, and it shows you the ticker of the stock for which the option is to be sold for, and the expiry date of the option here, and the strike price, and then the bid and the ask. Now they cheat a little bit in that they use the mid price between the bid and the ask, which you can see are fairly wide, they use that to calculate the annual return. And I'm not quite sure if I agree with that, but that is what they do. And so here you have the raw return in this column, and then you have the annualized return. Uh, this is a percentage of whatever money you have at stake. So the annualized return, you can see, is quite correlated with the implied volatility here. The higher the volatility, the higher the annualized return, because it is likelier that the option is going to end up in the money. So just a heads up for that. But what I used to do initially is I would go and I would look at each of these stocks, and I would see whether I liked it. And what I started doing recently is I will go through these and compare them via an Excel spreadsheet, which I will show you now, compare them to existing stocks that I have. So I sort of use this as an opportunity to get more of stocks that I already have because I'm familiar with them and I like them. So here we go. So this is just an Excel spreadsheet and just uses a formula where there's the matching between column A, which is what I already own, and what they're suggesting. And so here's one. This is Lithium Americas that I own. I got this one through options and I don't really want any more of it. So the one that I want to show you is WTE, and we'll sort of carry through with that example. So there's the one that I have, and here's the one that they're suggesting. So we'll go back here and we'll look for WTE, and it finds it here. So it says today is October 27th, and it says look for one that expires December 17th, and we'll use the strike price of 25. Now, currently, the current price is $26. So this is what you're sure to get, and this is the mid price. And so what that will do for you is get you a 23% annualized. So how they calculated that is they went 0.65. Well, they used 7.7. I'm going to use 0.65, and divided that by 25. They multiplied it by 365, and then they divided it by the I think it's around 42 days, give or take. And so that's how so my calculation came back with 22% return annualized. So I mean, for anything, that's a pretty good return. And of course, the worst case scenario is that you'll have to pay $25 for something that is worth 24 or 23 or 22. So if you were to buy the stock anyway, I still see it as a good purchase. So now that we've chosen a stock that we're happy with the option premium, let's just make sure that we still like it, because we're possibly going to get more of it. So WTE, which is West Shore Terminals Investment Corporation, a Canadian coal terminal, and they've recently signed a contract to also include potash in their terminals exports, and you can see that that deal happened there, which jumped the stock from $17 to close to 22. So I've held this one for a long time. I'm not advocating it. It's just being used as an example. So let's take a quick look. So first of all, the PE is right here, 14, which is fairly reasonable. It pays a dividend of $1 per share, which with today's price turns out to be 3.8% yield. Of their profits, that is a 39% payout ratio, which is definitely in the safe zone. It's not a gigantic company, 1.65 billion. And while we're on the screen, these are some analyst ratings, and you can see most people are neutral on it, and one person thinks it's a buy. I'm comfortable with it, so I don't see any showstoppers here. So, and of course, you're going to have a different experience on your brokerage, but just these are some of the things that I check for. So, let's see. Dividend growth rate, well, that's not great. They've actually cut their dividends some years back, which probably has them in the penalty box a little bit. Uh, they they are for that $1 of annual dividends, they are getting 2.3 in cash flow. So their cash flow is also able to service the dividend quite well. And the other thing I look for here is the debt to equity. I look for it to be under 1, and they are comfortably under 1. And the last thing on the screen I look for is for return on equity, which is a measure of how well management is allocating the resources that they have. So I look for 20. 17 and a half isn't bad, so we'll call that close enough. And then we'll look at some financials. What I'm going to look for is increasing revenues and increasing profits, ideally. So this is on a yearly basis: 330, 363, 395, and of course 2020 we dropped a little bit. So that's the top line, that's the sales and revenue. And net income, so you can see they've been profitable all the way through. It had an upward trend again right up until the pandemic. So these guys are kind of a steady Eddie type of company, and they're gonna pay me a dividend at the same time. Looking at it on a quarterly basis, uh, the last month, the last quarter was a little bit poor. Otherwise, they seem to have a fairly consistent revenue stream. So that's good to see. And profits, well, they're sort of trending down, but they are making a profit. So maybe something to keep an eye out on. And then finally, we can look in the research tab. So there might be a couple of different reports here. The quant report is sort of just the automated one, which I don't really give that much credence to. But we'll just wait for it to come up here. So the computer calculated that the fair value is about $25.26. So it's a tiny bit overvalued, and Morningstar is automatically giving it 3 stars. I would have preferred if there was a human-made Morningstar report, and there can also be a Desjardins a report that QTrade pays for. So no terrible red flags. Obviously, I'm familiar with this one. A couple of notes here. There's an economic moat right here, which there's none. So there's nothing that would prevent somebody else from running the same kind of business. Uncertainty is high as far as price fluctuations. Uh, it's and here's the ESG risk rating. So not great there. So this is how I kind of check before I would want to sell any put options on an existing stock. Another free tool that I like to use is a website called Stock Chase. So I type in the name of West Shore Terminals, WTE, in here, and what Stock Chase shows me is what experts on BNN, on CNBC, and anywhere else have said about this particular stock. So obviously, this is a Canadian stock, trades on the Toronto Stock Exchange. So it's going to be mostly on BNN. It tells you who said it and what the price was at the time that they said it. So the most recent one happened just 2 days ago. uh, Colin Stewart said that he follows it. There's concerns over ESG since they ship coal through their main terminal. They signed the deal for potash, which I mentioned, and so they raised their dividend and guidance recently. So the dividend increase wasn't reflected in the QTrade screens yet. There's also a lot of shorting, but the business is resilient. So he seems sort of optimistic about it to some degree. Ryan Bushell back in June sort of had it as a hold. This was, I think, previous prior to the deal, and as you can see, they were still priced at $17 when he gave this opinion. Another one from Colin back about 7 months ago, where he said he sold out of it. So definitely be careful, or take a specific look at the sells. Don't just look at all the recommendations and buys from the experts. Don't just sort of confirm your own opinion. Also look at the opposite way. Uh, Robert Lauzon apparently in the past said that he had as the top pick, and since then it was down 31%. And I mean, this was back a year ago, and it was at $14. And so this would sort of be the process I would follow to check on the stock to make sure that if I do get it, that it is a decent investment that I would want to keep holding on to. The next check I would perform before considering selling an option on one of these stocks would be, I would look at Yahoo Finance, and I would use a little bit of technical analysis, a little bit of day trading technology, if you will. And so there's a couple of statistics that Yahoo calculates for you. One is the RSI, which is the relative strength index, and the other one is the MACD, or moving average convergence divergence. So they're both momentum indicators. And so the RSI, and I'm not going to go through the calculation, but it basically produces a number between 0 and 100. And you can see there's indicators here for a 30 and a 70. And the purple line right now is at 55, and it's trending downwards. So if it goes above 70, that means it is overbought. And if it goes under 30, then that means it is oversold. So right now it's probably a little bit more towards the overbought side, but it looks like it's trending downwards. So that, as far as the direction that the stock is going to go in the next 6 weeks, would be sort of a negative indicator for me, meaning this stock might keep going down and I will end up with it. As I said before, that's not really an issue. But if if it happens, I might be out some money because I'm buying the stock for more than it is worth at the time. So I would prefer the stock to go up because I already own it, and then that way I just end up pocketing the the premium. The absolutely best case scenario is that the stock goes down to 1 penny above the strike price, meaning I don't get the stock. If I want it, I can buy it myself, and there would be less fees to purchase it outright rather than getting it through the option. So the fact that it looks like it might go down in the near future is sort of a negative indicator. So looking at the MACD, it compares the 12-day exponential moving average and the 26-day exponential moving average. And basically, if the purple line crosses upwards over the orange line, that's a positive, and you can sort of see how that's reflecting in the stock price. It had crossed over the orange and is sort of moving down further away from the orange. So again, even that indicator isn't a great sign. The stock have a might have a leg downward here. Um, since we're kind of uh, doing short-term analysis and technical analysis, uh, to do a little bit of charting, I can sort of see that there might be a support line here somewhere around, let's say, $24 a share, give or take, because it looked like the stock went down, bounced off, went down again, and bounced off. So I would sort of think that there might be some support at 24. But if you recall, the strike price that was recommended was 25, so that doesn't really help us. The stock, if it does go down to 24, is going to be in the money. So that's the kind of analysis that I would do on Yahoo Finance. The next thing that I would do is employ a little spreadsheet work that I did in the past. So again, on Yahoo Finance, I go into historical data where you can get historical information in a specific format, which is something that I'm going to export and I'm going to use an Excel macro on. So do as much as you can. So do maximum. Frequency is going to be monthly, and what I'll do is I'm going to download this, and then I'm going to run a macro on it that I wrote, and I'm going to put a link to that macro in the description for you. So basically what we do is we go developer macros, and you can of course name it whatever you like. And I had copied and pasted it from here. So here's the macro. It's not terrifically long, but what it does is when you run it, is it enables us to get an analysis by month of whether the stock went up or down. So green obviously is that it went up that month, red is that it went down, and all the macro does is it just calculates the difference between the previous month end and the given month's end stock price. So that's how you get the values. The real power comes here, where it adds up the number of greens for positives and number of reds for the negatives, and then it gives you a strength of the direction. So, for example, in February you have 9 positives, 9 negatives. The strength is 0. It's absolutely nothing. So because I'm going to be looking for something that ends in December, I'm going to look at November and December, and that's not really giving me much comfort historically. For November, there were 10 positive years for November and 7 negative, so it's something. For December, it's actually negative. You have a -4 strength. So it's not really, it sort of comes out neutral. But if I look ahead to next year, it looks like July and August seem to be very positive months for the stock. 14 years positive versus 4. So it's sort of a nice little historical look at what the stock has done in the past. Of course, there's tons and tons and tons of other factors that play into what the stock has done back historically. But if you're looking for seasonality, if there is a significant correlation for a given month, you might look at that as either a good indicator or a bad indicator that the stock is going to be up for that year. As I mentioned previously, I had subscribed to a training company called Options Play. I subscribed about a year and something ago, and I was able to get a free version of their application for Canadian stocks. And I've stuck to selling puts for Canadian stocks only. And so I've been using this wonderful application for free. I'm not sure if you have to pay for Canadian anymore, and I know you get 30 days introductory for US stocks, and after that you have to pay. But in any case, so what you do is you open this up, you log in. On the left, in the left pane, they have some ideas for trading options on. Sometimes I just kind of look through it, but I usually just use the optimized put spreadsheet I had shown you earlier. So what I did today for West Shore, I went and I entered it in here, and you get a couple of things in a central pane. One, you get what the trends are. So I'm looking to be about 6 weeks out, as I said, for the expiration date. And so I'm interested in both the 1 and the 6 month trends, and they both seem to be bullish. Also down here, you can see that they're bullish. You can see how things have been going. I can put this out to 6 months, and you can see how the stock has trended. You also get a technical score up here. So this is just compared to the rest of the market, how this stock has been doing. What I find quite valuable, I'm going to flip us back to the 3 month. What I find quite valuable is that it puts in support and resistance lines. But note that these are system generated. I would, for example, put another support line here, maybe at 23. Looks like there was a bounce at 26 as well, where it came down and went back up. So they're thinking support at 20 and 22, which are drawn in. I'm seeing one perhaps around 23 and a half, and I'm seeing another one around 26. Because we're aiming to do 25 as a strike price, neither of them, well, the 25 would help. The 26 would help. The 25 strike price could possibly be protected by support at 26, but then the 23 and a half wouldn't. So that's yet another piece of the puzzle that we have a look at the technical score, and we have a look at the trends, and we have a look at any support lines and lines of resistance. It looks like they're thinking there's one at 27, which I do believe, but that doesn't really affect our decision. Moving on to pane number 3, the rightmost pane. You have a choice between trade and income. I'm going to flip us to income. And then it says, do you own shares? And for our purposes, I'm going to say no. So that way it's going to direct us to the put selling. So I'm going to say no. And it basically suggests that you should sell a put at the strike price for 24, and it would be for expiration of December 17th. And so that is the right expiration date, but the spreadsheet earlier recommended a 25. So what we're going to do is we're going to go in here and we're going to modify this. So December 17th is 50 days out. I'm going to move this to 25 because that's sort of what we've been working with. And then things have changed up here. And so the annualized return is, according to the current prices, is 15%, which we calculated we would probably do a little bit better. And so then what you can do is click trade. Either of the trade buttons will do, and it gives you a very nice summary. So it says, well, here's the bid and the ask that we discussed previously. It's using the mid price for all the calculations. It's telling you you're going to do a sell to open, which I'll discuss in a little bit. Here's the expiry, and the strike price that we chose was 25. The premium here is 55, which is the same as the bid price. That you could get right now. We're hoping to be able to get closer to between the bid and the ask price. Now, the most important part is the strategy checklist. So we see some red, amber, and green lights. So we're going to click and we get a little bit of information. So it tells us, according to the past movements of the stock and the past volatility, the strategy at 25 strike price is likely to be expiring only 65% of the time. So you would probably want to have this somewhere in the 70s, and 80s would be great. So it's sort of telling you this is lower than optimal, which is which if I'm okay with the stock, then that's why I would set the strike price at 25. If you were to put it lower, like they had it at 24, then there would be a higher chance of it expiring worthless. Annualized return, 15% is what they calculated. We calculated a little bit higher. Still good. I mean, if you compare it to a 2 or a 3% dividend, that's doing really well. This is an important one. There's no earnings date because earnings tend to have a significant effect on the movement of the prices of the stock. So it's telling you there's no earnings between now and when this expires. There could certainly be other announcements which would affect the stock price, but there's no official quarterly earnings planned. And then they tell you about the spread and the liquidity. So it says that the bid and ask spread is large, and so it's suggesting to use the limit orders to sneak up on the mid price. So I'll show you that in a little bit, but I definitely do that as well. So you cannot transact anything here. This is just a research tool. And then I will show you how I go into my brokerage account and actually would enter the trade there. But this gives you all the information that you theoretically need. I've added additional bits as I showed you, but in here is where I get a lot of the information that I need to make my decision. So here we are in my QTrade account. We've got West Shore terminals all queued up, and we are going to go to the options tab, which is only enabled when I applied to be able to do options, and I had to get a margin account and so on. And here we have the the options chains, and they're organized by expiry date. So here you have the monthly expiry, which is November 19th. That is 22 days out, so that's a little bit short. So I'm going to flip us to December 17th, so that's 50 days out. And you have calls on the left side, puts on the right hand side. So we're going to ignore the calls, and we're going to look at the options chain for puts. So you can see here the green part is in the money because the current price is $26.55. So 27 for puts is means that the stock is in the money, and we were going to do out of the money at 25. So this is $1.50 below the current price. So we're going to do a quick calculation again. You can see that the bid here is 55 cents per share. So what we're going to do is just to do a quick confirmation. So we're going to do 55 divided by $25 per share is the amount of money at stake. We're going to annualize it by multiplying it by 365, and then we're going to divide it by 50. And so this is now showing 16% return. Uh, in reality, what I'm going to aim for is somewhere between the 55 cents and the 75 cents. So probably 62, 63 is sort of where I'm going to start off. So this is how it works in QTrade. Other brokerages will have a different interface. QTrade will only let you do one option at a time. For some more sophisticated option strategy where you use 2 or even 4 different options all at the same time, I would have to enter separately. But so this is how I do it. I click on here, and it gives me information about the option. So you have December 17th expiry, 25 is the strike price. You notice that there's very little trading here. Uh, the last and the change are all zeros. Interest means that there's 10 contracts of this option, and I'll explain what a contract is in a second. Out there, that's sort of an indicator of previous people selling this option, but obviously it's very thinly traded. And this bid and the ask is provided by a market maker. And a market maker is an individual who's trying to make money, not trading options, but by buying and selling options and making money off the spread, meaning they make money between the bid and the ask. They also provide liquidity for the market, meaning if there's no actual buyers for this option, uh, I wouldn't be able to sell if it wasn't for the market maker. This way, I will be able to sell the option. It may not be at a price that I want, but this is what they're offering, and they're the only game in town. If you go to, let's say, a Royal Bank and you look at their options chain, you're going to get far more liquidity, far more people trading, and it'll be regular people, not just the market makers. But so I'm going to go in here, and I'm going to click on this, and I'm going to click sell. As I've mentioned previously, I've never purchased the option here, so I'm going to click sell. I'm not actually going to execute this, and so it shows in here It's going in my margin account, Markets Canada. Here's the symbol. This is the expiry. This is the strike information. And now I get to choose, am I going to be buying or selling, and puts or calls. So I'm going to do sell a put. And here's kind of an interesting thing, which is confusing for about 10 seconds. Um, if you're doing a regular stock, if you're purchasing it, you are doing a buy to open a position. And then when you sell the stock, you are selling to close a position. Here, because I am selling an option, I am selling to open. So, and then if I were to want to get out of it, I would be buying to close. So those four combinations are a little bit counterintuitive compared to stocks, but because selling options is sort of the reverse of buying stocks, that's how that works. So that's what the close is. That's not what I'm trying to do. I'm going to be doing open uncovered, meaning I have I don't have the stock, so I just have cash. So I'm going to do that. Number of contracts. Um, Really, everything for options is in the numbers of shares, except when it mentions contract, which is in hundreds. So all the information previously, the 55 cents, bid and the ask 75 cents, that's all per share. Uh, but here the number of contracts is in hundreds. So with the strike price being 25, I usually aim to be on the hook for a $5,000 to $10,000 per trade. And so if I wanted to be on the hook for 5,000, I would enter two, because that means 200 shares. 200 shares times 25 is 5,000. If I was braver and I wanted 7,500 to be at risk, I would put three. And if I really love this stock and I wanted $10,000 worth, I would put a four. The order type, as I said, you would want to do a limit. And so previously we saw that the bid and the ask spread was 55 cents to 75 cents. So I might start this at, let's say, 65 cents. And then I do a review order. And again, your brokerage will have its own method of this. So here it kind of gives you the whole summary. It tells you how much I'm going to get. So if this were to execute, and there's no guarantee that it will, then I would get $260 for the 400 shares. And here's the commission, so I would get almost $250 in my pocket. Here it shows you what happened previously. We saw the 55, this went down, and then it tells you what the stock is currently doing as well. So this is sort of a summary. So if I click submit order, it would sort of just sit there until a market maker decided to to make the to make the purchase of what I'm trying to sell, and there's no guarantee that they will. So what I would do is after it sits there for an hour at 65 cents, I might come back here and I might lower it down to 62 cents or 60 cents. And then I would let it sit, and then it's up to me, depending on uh, how much I like the stock and what price I want to get. I've sort of made it a policy not to have money coming into me to be under $100, just because it just doesn't seem worth it. And of course, the commission. For me, the commission is $6.95 plus $1.50 per contract. So that's where you have $6.95 plus another $6 comes to um, well, yeah, around 12. So that's how I would make this sale. After a put sale has been executed, it ends up looking in a very interesting way in your portfolio. So down here you can see I have 6 put options that I had sold, and they show up as negative. So again, here it is in the number of contracts. So for AQN, I'm on the hook for 400 shares. And when you mouse over, it shows that this is the November 19th expiry, and the strike price is $18.50, for example. And so this is what I sold it for. If I wanted to get out of this, if I decided that I did not want to get 400 shares of Algonquin and pay $18.50 for them, because currently the price is actually $17.94, so that one's in the money, then I would have to pay 79 cents per share to get out of the option. So it sort of calculates in an awkward way what your position represents. So I sold them for 93 cents a share. After fees, after the commission, I pocketed $172.05. The to get out of it, if you remember the bid and the ask spread, I would have to pay $316, which is the ask, in order to be able to buy back the puts that I had sold. So currently I'm in a negative position. On most of the others, they had gone up. They're out of the money, and so it's showing us green. And so, for example, if I sold Manulife options, I pocketed 133. Right now, if I wanted to get out of it, I would have to pay $102. So I'm still positive. I would still have to pay around $10 in commissions. So I would end up getting $20 net. Uh, so this is what it looks like. It kind of looks quite awkward because of the negatives. But remember, when you're selling options, when you're selling puts, you are selling an obligation. So that's why it stays in your brokerage account, that you're on the hook for these. And this is where, when you add all of these up together, it's about $45,000. So if all of them are in the money by November 19th, then I would have to purchase $45,000 worth of shares in these 6 different stocks. So that's how that works. In order to keep an accurate record of all of my options selling, I keep a spreadsheet. This is so I know how much money I'm making, and if I am not making money, then I would want to change what I'm doing. So this is to make sure that I have accurate information for decision making. And so I enter everything very carefully. So you can see here on October 5th, I sold 6 puts, which I had shown you earlier. They all expire November 19th. This is the number of contracts and times 100 for the shares. This is the amount of money that is at stake. So if I do get the stock, this is how much I am paying for it, no matter what its price is. And this is the amount of premium after fees that I received. And this is the annualized return on the fee with respect to the amount of money at risk, and I showed you that calculation earlier. So in the past, you're either getting a result of expiring worthless, so that's the greens. That's generally what I'm going for. The red is where I received the stock, and generally I lost money on it because the stock was worth less at the time than what I was buying it for. There's definitely exceptions like this one where I paid 7,000, the stock was worth 6,950, and I received $236 premium. So I still ended up, even after the fees for getting the stock, I ended up pocketing $131. But usually you end up losing money because the stock went down further than what um, than what the premium covers. So there was one instance where I bought the option back, and I still ended up making money on it. Um, I found out later that the option actually would have expired worthless, so I ended up spending $259 to buy the option back for nothing, but that's just how it goes. So usually they expire worthless, which is what I'm going for, not always. And as you can see, you can still make money even when you get the stock, because sometimes it's very close. The stock was just barely in the money, so I still ended up making a good amount of money. And of course, my brokerage always ends up making a nice amount of money. So far, in my metrics, I've had 78% of the options that I've sold expire worthless. I've sold 92 for the next expiry, which is November 19th, like we talked about. I'm on the hook for $43,000. And so far, it has provided a cash flow of 15,000 and a half dollars over just over a year. So it's been interesting, definitely extra income. My final gain percentage is 18%. So this is when you figure in all of the losses for getting the stock at a higher price than it currently is. So even then, I'm still making 18%, which I think is not bad. And I always try to have at most about $50,000 at risk, especially in volatile markets. You don't want to have too many uh, puts being sold out there because you could very well have to purchase all of those stocks. So I wanted to illustrate why I have chosen to be selling puts contracts as opposed to using any other sort of a strategy. And so this is the 10-year chart of the Toronto Stock Exchange. And as you can see, while there's definitely valleys and downturns, overall there is a long-term upward trend. And so what I am doing is, for extra money, I am selling promises to buy something at a lower price than it is currently. The odds are good that with the upward trend, those contracts are going to expire worthless. And just in case I get the stock, I will benefit in the long run from the market going up, and the stock is still going to appreciate for me. So I don't really see the downside with the selling of the puts because I get extra money. The market is going to go up anyways. I get the stock cheaper than it is currently, where I would theoretically be willing to buy it even today. And of course, the extra cash flow is always nice. So getting a stock at a discount never hurts. So and even if it were to go down further, had I purchased it normally, I would still hold on to it. So it doesn't bother me that I'm having to pay more than the stock is currently worth by having to buy it at a higher price than it is currently. This concludes my strategy on selling put options to generate cash flow most of the time with no obligations, and the rest of the time to acquire good stocks that I would have bought anyway. When I do acquire the stocks, I get an extra premium in cash to buy the stock, and I buy the stock at a cheaper price than it was at when I decided to get it. I will do another video for covered call selling, which, together with this video, is the wheel strategy. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.